Evening, folks, and welcome. I'm sure there's going to be more people joining shortly, but we have limited time this evening. So I'm just going to jump right into it, and this will be made available as a recording as well within the Facebook group. So, as I mentioned in the notification post, this evening is about getting into the discussion around technical analysis, in particular, the technical analysis methodology that I favor, which, as most of you will know by now, is advanced price action technical analysis. What does that mean? Well, first of all, it means that unlike most technical analysis, we don't place any emphasis at all on indicators. In fact, uh, the premise of price action technical analysis is that indicators are simply a rehashed version of historical price data. A lot of people look at indicators as a means of being able to find a way to predict the future. And in fact, all technical analysis is often misused in that way, where folks assume that by being able to read a chart, it's like being able to read a map. If you can read a map, well, you can be pretty sure about where you're going to end up in the next 5 minutes or 2 hours, depending on the time of your expected time of your journey. And so people will very often look at technical analysis as a way of mapping out the chart so that they can have an idea of what's going to happen next. Now, that's not the purpose of technical analysis at all. And for those of you who have done my training, you should be well familiar with that by now. But then, of course, for most people, it begs the question, well, what on earth do you use it for? Well, the fact that our brains are always looking for a means of predicting the future, that's just part of the human condition, a very big part, in fact. Uh, as you all know, Danny Kahneman, in his studies that got him a Nobel Prize, has described the human brain as a predictive engine. So it's only natural that we always fall back on that instinct where we want to try and know what's going to happen in the future. And of course, as soon as you've got real money at stake as a trader, you become very uncomfortable with the fact that you really don't know what's going to happen. Which is why most people, when they start out trading, keep looking for a means of being able to predict the future and won't take a trade until they have been able to convince themselves that they know that the trade will be successful. And of course, that's a very, very frustrating exercise because that's just not possible. There is no way that anybody knows effectively ever what's going to happen next in the market. If there was somebody who was able to predict, even if it was just at certain points in time, exactly what was going to happen next, well, that would be just as good as knowing what the lottery numbers were going to be every single week. So, of course, no one has been able to do that. But it doesn't stop people from trying. And of course, for those of us who are on the other side of those trades, we don't mind. We've got to get our money from somewhere. Remember, this is a zero-sum game, and there's always going to be a lot more losers in the market than winners. And that's one of the main reasons why. So coming back to the question then, well, what on earth do we use technical analysis for? Well, it's about understanding probabilistically, and that's a very important point to take on board, probabilistically, where we are at in the life cycle of a market. And there are different stages of the life cycle in the market. Those stages vary between ranging and trending primarily. And obviously, then those can be broken down into finer sort of definitions of the life cycle of the market. So in a trend, you can be in both an impulse wave and a corrective wave. And, likewise, in fact, even in a range, but also in a range, you can be in the middle of a range or you can be at the boundaries of a range. And the way you would respond to that would be different depending on where you are at in the life cycle of a market. In particular, the thing that you would do differently is the choice of strategy will vary depending on where you're at in the life cycle of a market. So probably one of the points where you're least likely to take a trade would be in the middle of a range. If you do have a ranging strategy, clearly it makes sense to enter your trades at or near the expected boundary of the range that you're looking at, and look to trade that back towards the mean, or even perhaps to the other side of that range. And that would make sense. Likewise, with a trending strategy, if it was a breakout strategy, you would look to enter your trade literally at the moment where you have reason to believe that you've had a breakout from a range. If you're looking to trade a trend continuation strategy, you will wait for first a breakout to give you reason to believe that you probabilistically, again, are in a trend, but then wait for the first retracement wave. And in fact, wait for every retracement wave in the trend until that trend is over. If you are trading an impulse type strategy, then you would look to identify those moments in the market's life cycle where A, you're in a trend, and B, where you have reason to believe that the last retracement in that trend has come to an end, and you're looking to trade the next impulse wave in that trend. So those are just a sample of examples as to different strategies and when you would apply them. Now, that's very important. It's absolutely essential to understand for each strategy that you trade, what sort of conditions that strategy is made for. What are the ideal conditions for that strategy? You need to know that first. Then, knowing that, you then have the challenge of being able to answer those questions or being able to evaluate those selection criteria so that you only apply the strategy when the conditions have been met. So that hopefully all sounds logical, and it really is very logical. The problem that a lot of people have is that they will still, your mind will still tend to want to know that the next trade is going to be successful. So having identified the appropriate conditions for a strategy, you will naturally have expectations around the outcome of a trade that you take when those conditions are met. And of course, that is just you and your mind falling back into a deterministic mindset instead of remembering that trading is a probabilistic exercise. It's about taking only good trades, in other words, trades that conform to your rule set, which includes the appropriate conditions. And win or lose, you put together a population of trades. So once you get, as we are doing with the challenge, you want to get to at least 20 trades. You want to take the next 20 valid trades. If you do take the next 20 valid trades, you would expect it to be somewhere around the expected outcome, depending on what the strategy is. So as an example, if we were to take one of the impulse type strategies, we don't expect really to win more than about 40% of the trades, depending on your targeting. So if you're using standard targeting or advanced targeting, of course, that does vary. But we expect to lose more than half of the trades, which has all sorts of advantages, which we won't get into now. And I expect that most of you have been through the training that I've done on this. But at the end of the day, one of the advantages is that it kind of defuses that emotional attachment that you have to a trade if you actually expect it to lose. And that sounds crazy to most people. Many of you have heard me ask that question. Would you ever take a trade that you in fact expect to lose? And most people look at me like I need to be admitted to a psychiatric ward. But in reality, the most advanced strategies and advanced traders do exactly that. And of course, it's because we are blind to the other side of that equation, which is not just the probability of success, it is the potential reward relative to the risk you're taking. So, if you're going to lose 6 out of 10 trades, you don't mind if the winners are 3 times as big as the losers. And you've seen me put this together many times. If you were to take 4 winners at 3% each, that would be gross 12% in terms of winners. And if you have 6 losers at 1%, that's gross losses of 6% losses. In other words, your gross profits 12%, your gross losses is 6, you're up 6%. Even though you lost more than half of the trade. So it's not about knowing what's going to happen next. It's about being able to apply your strategy when the conditions are appropriate and doing that with that probabilistic mindset. All right, so I know I'm repeating myself here quite a bit in terms of things that you've heard from me before, but it really does bear repeating. Okay, so what I'd like to now just talk about then is a little bit more about how do you actually do that? How do you go about evaluating the market, seeing where you are at in the market's life cycle, which then, of course, being able to do that, you'll be able to answer the selection criteria or evaluate selection criteria and answer those selection questions. So the first main question that it sounds so simple, and I've seen the question brushed over most of the time in training. You'll find that very few people who offer training will, in fact, explain to you how to identify probabilistically whether the market is in a trending phase of its life cycle or a ranging phase of its life cycle. You'll have comments like people say, well, just step back, zoom out and have a look at the bigger picture. That's pretty useless. It doesn't help anybody. You need to have a very rigorous way of evaluating any chart, in fact, so that you can come up with a probabilistic answer of yes, it's trending, or no, it's not trending, or yes, it's ranging, no, it's not ranging. And it really is one or the other of those two. And you must have a way of answering that question, even though in hindsight, very often it's going to turn out that you were wrong. Because trading is not about being right. Trading is about making money. Trading is about having an edge that you can apply consistently in the markets that has a positive expectancy. It's not about knowing what's going to happen next. And so our technical analysis methodology is there purely to allow us to do just that. All right, so the main question then is, probabilistically, do we have a trend, or is the market currently in a trending phase of its life cycle or a ranging phase of its life cycle? Now, from a price action point of view, we start off with a very simple premise, which it works very well. And basically, it's to say that if we are in a range, then we are not in a trend. If we have a breakout of our range, it means that we are no longer in a range, which means we are in at least a potential trend. If we could say that we're in a potential trend, we then have answered that first question, especially if you're trading a trending strategy. That's the first sort of box ticked, if you like. If it's a breakout trending strategy, that's the only box that you need to tick, and you would literally then move from selection to timing and apply your timing rules right there and then. If you are trading a continuation strategy, you would need to wait for the start of a retracement of that trend. And if you're trading an impulse strategy, you would need to wait not only for the end of the retracement, but for the identifying that retracement wave, or phase 2 wave, as many of you guys call it, you have reason to believe that has now come to an end. So that's what we're kind of looking at over here. Now, in the weeks leading up to where we are now, which of course in the last 48 hours or so has been the 2020 US elections, we have seen the markets enter clearly into a consolidation, which of course also means ranging. But life's not as simple as just being able to say, well, we're in a range. You need to, again, probabilistically, be able to define the boundaries of your probable range. The boundaries of a range are the significant support for the lower boundary and resistance for the upper boundary, support and resistance areas that are containing the market and likely to continue to contain the market. So much so that if they fail to contain the market within those range boundaries, you have reason to believe that something fundamental has changed in the net opinion or sentiment of market participants. So just looking at Euro USD over here, you can see that I've got a couple of boundaries here, and don't worry too much about the historical ones. We'll talk about that more in the future. But just starting off with a view of this top resistance boundary and support level at the bottom over here. Let me just work on this a second. There we go. And in fact, you'll notice, I mean, these lines have been here now for several weeks. And despite the fact that we've got something fundamental, very important going on, which is, of course, the US elections, that support level was nicely respected yesterday. Now, I'm actually a little bit disappointed, to be honest with you, because I was really expecting breakouts across the board. Of course, the result for the elections is not in yet, although I think a lot of people have priced in the fact that potentially Biden is in. But I really was expecting a little bit more directional volatility here. We haven't had that. But in any case, you can see that despite the fact that I cannot actually know for sure whether this is in fact the top of the range and this is the bottom of the range, it's working pretty well. And that's kind of all we need. So using a price action methodology here, which in this case is the historical Donchian channel, you can see that first of all, the support level has been nicely respected. And so far, so has the resistance, which means that if I'm to say that this area here is my range, I'm still very much within that range. And I cannot say yet that I'm trending on this instrument. However, should I get a breakout, then I absolutely can. So let's go and have a look at an example of that. So here we have the dollar yen, the USD JPY. Now, the day isn't over yet, but we're not that far off from the day's end. So assuming that this candle, today's candle, closes below the support level, that then is, in fact, an indication that we have had a breakout of our range. You will notice that I've got a couple of different levels over here, and we can go into that in the future. But the short red lines are for impulse strategy, and the longer blue barrier is for a continuation strategy. But nevertheless, these are my range boundaries, inner and outer range boundaries. Likewise, if you look back a little bit further, you'll see that I've got some other boundaries over there which give me additional information for alternative support and resistance levels that could potentially contain the market over a longer time frame. But clearly today, if this were to close at or around where we are at right now, we would be able to say that we've got a channel breakout and therefore a range breakout. And despite the fact that we've been in effectively a range for quite some time now on this instrument, we'd be able to, again, probabilistically say that we have transitioned from a ranging market into a potentially trending market. And I say potentially trending because an established trend as opposed to a potential trend has quite a rigorous definition. And I will get into that in more detail in the future. But for now, the most important thing is to absorb this basic principle that if you are able probabilistically to define the upper and lower boundaries of a range, and remember, it's probabilistic. It's not about prediction. It's not about being right. It's about having something that works. If you're able to do that, then you are able to, again, probabilistically answer that question. Do I have a trend? Even if it's just a potential trend, yes or no. If you cannot answer that question, you can't do anything worthwhile in trading. It is the most important element of technical analysis, is to be able to answer that question. If you look at the indicator-based versions, you'll notice that they too look to try and answer that question. And very often they will use things like moving average crossovers. That's a pretty big one. If you look at your Ichimoku clouds as well, if you are outside the clouds or inside the clouds, that too gives you an indication of whether you're trending or ranging, and so on and so forth. So that question is always there. This is how we answer it. But as I mentioned, being able to define these levels is a prerequisite in being able to do that. Okay, so that's the principle behind it. What I'm going to do in future training sessions then is I'm going to show you various options for identifying these levels. There are several different options. The historical Donchian channel is proprietary to GoPro Trading and to our fund management company. But of course, folks that learn from me are welcome to learn it and use it. But it's not something you're going to find anywhere else. You'll certainly be able to learn about standard Donchian channels anywhere, but historical Donchian channels are, I think, a very common sense extrapolation of a good idea. But yeah, that's something that we came up with over the years. And it is one of the best ways of being able to answer that question. Do we have a trend? Yes or no? If we are outside our HDC channel, the answer is not only are we in a trend, but we're in a strong trend. And of course, that's another form of categorization in the market's life cycle. Not only if you're in a trend, yes or no. If the answer is yes, is it strong or weak? And are you in an impulse wave or corrective wave? Those are three very important distinctions inside of a trending market, and those are the subcategories of the market's life cycle. Okay, so I will teach you the historical Donchian channel going forward. We will also look at the MW patterns, which is really just a simplified version of that, especially when you're doing a four-wave analysis, as I do. You'll notice that on all of my charts, I simply look at the last four waves, including the current incomplete wave. So 3 completed waves in the current wave. And in this case, of course, what we are looking at is an M pattern here. But as soon as this bearish wave comes to an end with an isolated low, then we will simply be leapfrogging that. And of course, that turns into a W pattern. And if you are, depending on what strategy you're trading as well, it's obviously very important as to which of those you would be looking for, both in either in a bullish or in a bearish trading direction. But that's not the only thing we look at. We don't just look to see if it's an M or a W. If it's an M pattern, we look to see if our C close, and this would be point C here, is below point X for bearish trend, which would be an M pattern, and a W pattern for going in a bullish direction. We'd look for our C close to be above X. So we're going to talk about that in future trading sessions. There are other methods as well. The LPO methodology for determining a potential range. We will look at that as well in the future. And those, to be honest with you, are more than enough in order to be able to apply price action principles to your technical analysis. All right, so folks, I know that many of you have heard this from me many times before, but we're also talking to some new people who've entered our 2020 trading challenge, and understanding these underlying principles first is vital. There's no point in us delving into the more intricate stuff until you understand the why behind what we do. So I don't want to teach you the how until we've covered the why. So any questions for you folks who are in the call this evening? Just pop it into the chat box, please. That's, I'll have a look at it there and answer it. And for those of you who are watching the recording, please do pop your question into the comments with this video. All right, any questions? You guys all good? Cool. All right, so that's great then. If there are any as well, if you do think of any, please do just put them into the post in the Facebook group, and I will ensure that I either answer it there, or of course, what I can do if it requires a bit more explanation, detailed explanation, then I will cover it in our next training call. I'm expecting to do another training session on certainly on Tuesday evening of next week. But as always, please do look out for the announcements in the Facebook group. So I think a lot of folks missed it today, so it's pretty quiet in the room tonight. But yeah, and we're going to try and do Tuesday and Thursday every week at least. And if there's reason for us, a need for us to do any more training, I'll happily do that. So Johan's asking, how would I see this breakout for the H4 strategy? Well, the H4 impulse, certainly what you need for the H4 impulse is reason to believe that we are in a trend or a potential trend on daily, which is exactly what we're seeing here. Now, if we get that close outside of the channel here, that means this is an impulse wave on this time frame of a potential trend, and those are the two primary selection criteria that need to be met in order to trade the H4 impulse. What you then do, of course, is drop down to the H4 time frame. That would be from the start of the next trading day, which of course would be from midnight to night. And as you know, for the H4 impulse, it takes advantage of that daily cycle of activity in the markets, where we will often see through to sort of lunchtime, New York time, in the New York trading session, a lot of activity. And then after lunch in New York, when all the traders go down to the bar there, it's not London, when they go down the pub, the activity kind of dies down a little bit as well. And you start getting some profit taking. And profit taking, of course, is what very often leads to a retracement wave on that lower time frame. So assuming that there's not going to be any major announcements in the next 8-12 hours from now, and that's quite a big assumption, because obviously they're still counting ballots and what have you. But in an absolutely bog standard day, we would expect to see a few retracement candles here on the 4-hour time frame. And as you know, then we look to identify that final selection criteria on the execution time frame, which would be an impulse candle. Non-farm payrolls could be a problem, absolutely. So I'm just talking here generally. So obviously we recognize that if you are, as it is tonight, the evening before non-farm payrolls, then that too would be something that potentially you might want to avoid. It's not something that I specifically avoid, to be honest with you. I am perfectly happy with losing more than half of my trades with an H4 impulse. And especially if you're using advanced targeting, I've got a very limited downside. So yeah, I might even lose 75% of my trades on non-farm payroll Fridays. But the reward to risk ratio, if you're using advanced targeting, is much higher, because the market, if it goes in my favor, will go much further than usual. So again, it's not just about avoiding losers, folks. That's what amateur traders do. They look to avoid losing trades. Professional traders focus on not missing the winners. Why? Because they trade strategies where the amount that they risk per trade is much smaller than what they stand to gain. So it's very expensive to try and avoid losers. It's totally counterproductive. And that's something that new traders just don't get, because the human brain and especially when you've got money involved, is tries very hard to avoid negative outcomes. Anything that could cause you pain. That's how we've succeeded or survived as a species. We've been very good at learning to find ways to avoid negative outcomes. In trading, you can't do that. If you do that, if you try to do that in trading, then sooner or later you're actually going to blow your account. You're going to lose all your money. So, but there's nothing wrong with being prudent either. So, if you want to avoid especially non-farm payroll Fridays would be the biggest regular monthly news event, then that's fine. It's absolutely fine. But that should be part of your rule set, and you need to be consistent with that. The best time is still between 4 and 8 on an all-day a week. Well, you know, and again, this comes back to it depends on what targeting methodology you use, and also depends on if you have trade software to help you manage your trades 24 hours a day. So it's obviously impossible for most normal human beings to trade a strategy like the H4 impulse if you are trading it around the clock. But we will be looking in more detail at the H4 impulse. So let's just park that for now, and I'll show you some additional stuff that you can look at taking advantage of when trading H4 impulse. Good, thanks for those questions. Cool. Alrighty then, so if there is anything else, as I say, please do pop it into the comments with this, when I post this video in the Facebook group. And as I say, I will either answer it there or I will include it in the next training session. All right, guys, so just keeping these nice and short training sessions. If we need to, we can extend it in the future. But yeah, I'd like to just keep it focused every single time we have one of these. And if we do need to do more sessions, then happy to do that as well. You're welcome. Only a pleasure. All right, guys, have a great evening further. And yeah, watch out for the markets. We still don't know what's going to happen. We never know what's going to happen, but it's a very volatile time in the markets right now. Let's, you know, if you're trading your live account, just please make sure that you are prudent about that. You know, so there's no need to try and engage in these extremely volatile conditions, especially when liquidity can also get very patchy. There's a lot of additional risk in market conditions like this. Great. I'll chat to you guys soon. Also, enjoy the weekend, and I'll speak to you next week. Take care. Bye for now.